72 hours after the conflict erupted, global energy insurance for the corridor was suspended. Not a single tanker had sunk. Passage through the strait remained physically open. Oil continued to flow, yet the system had already reacted because it prices risk, not physical reality. That distinction matters more than anything that follows. The visible explanation, there's a conflict, oil is threatened, was wrong. This was not a supply shock. This was the price-setting mechanism failing under pressure, and those two things produce completely different outcomes, on completely different timelines. The Strait of Hormuz stretches 33 miles at its narrowest point. Usable shipping lanes are 2 miles wide in each direction. Through that corridor, roughly 21% of global seaborne oil passes on any given day. Demand swings push that figure between 18 and 24%, depending on the season and the market. No alternate route can carry it. Pipelines exist but are partial, limited in throughput, uncertain in access, and politically conditional. When the strait closes, it is not supply that halts first, it is time. In this system, time is the most expensive variable. It is not measured in barrels, it is measured in days, and days compound. Layer 1. Insurance in the first 18 hours. The first 18 hours are quiet. Tankers sit in place. Contracts remain valid. Insurance policies are still active. Nothing visible has changed. The silence is misleading. The system has already begun reacting, not through cargo movement, but through collateral reassessment. Underwriters classify the region as a conflict zone. Standard war risk policies are suspended. This is an actuarial decision, not a political one. Risk models update, premium calculations shift, coverage terms become non-standard. War risk premiums spike fast. Within hours, daily rates begin exceeding 3% of cargo value on some routes. That number sounds small. It is not. At that level, transport becomes more expensive than delay. Owners make the rational decision. Pause the shipment. Wait for clarity. Pausing is rational, and it is catastrophic, because everyone pauses at the same time. Layer 2. Finance in the 48-hour collapse. Within 48 hours, the financing layer begins to fail. Banks stop issuing letters of credit for corridor-adjacent shipments. Letters of credit are the mechanism by which buyers and sellers trust each other across international borders. Without them, no transaction clears. Buyers cannot confirm purchase. Sellers cannot guarantee delivery. The physical oil exists. It is sitting in tankers or in storage. But the system has declared it unshippable, not because it cannot move, but because the financial infrastructure that certifies its movement has suspended operations. This is the first layer of the cascade. Insurance withdrawal halts financing before a single barrel stops flowing. The physical and the financial are decoupled, but only temporarily. The financial layer always leads. It prices the future. When it freezes, the physical layer follows on a lag. If you want to see how global fragility unfolds next, subscribe now and turn on notifications. Layer 3. Futures markets and the refinery. Signal futures markets respond independently, and they respond fast. Short-term contracts spike harder than long-term contracts. The curve inverts. Backwardation sets in, a market condition where near-term delivery is priced significantly higher than forward delivery. This is the market signaling. Get oil now, at any cost. The future will be cheaper, but right now, you pay. Refiners read this signal and begin stockpiling. Urgent purchases from multiple actors simultaneously push spot prices higher. Marginal refiners, those operating on thinner margins with less financial flexibility, hit operational limits. They cannot absorb the input cost increase while maintaining output pricing. They throttle down or stop. Flexible global processing capacity shrinks. The system moves toward the next shock with less buffer than it had before this one started. Layer 4. Logistics and days 10 through 20. By day 10, logistics begin producing their own independent constraints. Tankers rerouted around Africa's southern tip, the Cape of Good Hope. Add approximately 12 days to each voyage compared to the Hormuz route. Same tanker, same cargo, same destination. Fuel consumption rises, port scheduling shifts. But the real cost is not fuel, it is time. Time is capacity. Global shipping is built for just-in-time flow. Manufacturers keep minimal raw material inventories. Refiners maintain lean stock buffers. 10 days of additional transit does not immediately halt production anywhere, but 20 cumulative days of delay, spread across multiple supply chains compounding across weeks, begins closing assembly lines, quietly, without announcements. Production numbers lag behind reporting cycles. The damage is already done before it appears in data. Layer 5. Port backlogs and pre-priced scarcity. Ports begin to backlog. Port throughput is fixed. It cannot be increased on short notice. When more ships arrive than the port can process, queues form. Waiting ships accumulate insurance time. Rising insurance costs influence departure decisions for subsequent vessels. Fewer ships depart. Available capacity for upcoming deliveries shrinks. This is the mechanism of pre-priced scarcity. The market prices the shortage before the physical shortage exists. Futures contracts for delivery 4 weeks out begin rising based on projected port congestion, not current inventory levels. The price truth arrives before the physical truth. Consumers and downstream buyers are paying for a shortage that has not yet materialized in their supply chain. By the time it does, prices have already moved twice. Layer 6. Government intervention and sovereign stress oil. Dependent, heavily subsidized economies begin to buckle. Rising fuel costs swell subsidy budgets. Governments face a structural choice: borrow to maintain the subsidy floor, or allow domestic fuel prices to rise. Most borrow. Borrowing erodes foreign currency reserves. Import costs rise across all commodity categories correlated to oil, which is most of them. Policy responses are calibrated against delayed information. Decision makers are working from data that is 2 weeks old while conditions move daily. Every intervention is a calculated bet against incomplete information. Most bets are wrong, not because of incompetence, but because the information lag is structural and unavoidable. Delay is leverage. Delay is the system speaking. Layer 7. Agriculture and the 6-month echo. The chain reaches agriculture on a longer timeline. Fertilizer production depends on natural gas. Natural gas prices track oil prices, not perfectly, but consistently. Rising gas costs increase fertilizer input costs. Farmers facing higher input costs reduce planted acreage, shift to lower yield crops, or delay planting decisions. The impact on harvest is 6 months to a year away. Futures markets do not wait 6 months. Agricultural commodity contracts begin pricing in reduced yield projections by day 15 of a sustained disruption. The physical fields are unchanged. The crops are still in the ground, should or not yet planted, but the financial instruments have already discounted the harvest. This is the geometry of the system. Financial prices move on expectation. Physical reality follows on a lag measured in seasons, not weeks. Structural parallels: different commodity, different geography, different trigger, regulatory decision, not conflict. Same geometry, narrow corridor, high dependency, limited alternatives. The same pricing sequence follows. Financing stops first. Physical flow slows second. Price truth lags. When constraint geometry is identical, the nature of the trigger is irrelevant. Conflict, accident, regulation. The arithmetic is the same. Structural fragility renders cause irrelevant. The trigger is not the story. The architecture is the story. Day 45. The asymmetry of resolution. The strait reopens. Tankers begin moving. Insurance policies reset. The market begins pricing normalization. Crude prices fall. Headlines report it. Markets approve. Refined product prices remain elevated. Processing capacity has not returned. Small refineries that suspended operations require capital investment and operational time to restart. Capital waits until risk fully recedes, not partially recedes. Fully. Until that threshold is crossed, the capital stays out. The capacity stays offline. This asymmetry is structural. Closing is fast. Opening is slow. Destruction of capacity happens in days. Reconstruction of capacity takes months. This is not market indiscipline or irrational hesitation. It is a difference in timescales between two fundamentally different operations, stopping and starting. Consumers feel the price difference at the pump, in the grocery store, in utility bills. They cannot trace it. The mechanism is invisible to anyone not watching the refining capacity data, the port queue numbers, the LC issuance volumes. The system's memory. The system generates its own memory. Each closure increases baseline war risk premiums for the next one. Each accumulation of delays thins logistical buffers further. Each round of capacity destruction raises the floor for the next price shock. The system appears to recover. Prices normalize. Shipping routes stabilize. Inventory levels rebuild. But the thresholds have shifted. The next disruption starts from a higher floor and encounters a thinner buffer. The recovery from the last disruption embedded fragility into the structure of the next one. This is the compounding logic of systemic risk. It does not reset between events. Power does not come from controlling a strait. Power comes from the system's ability to function after losing it. From reserves deep enough to absorb the insurance freeze, the financing gap, the logistics delay, the refining shortfall, the agricultural lag. From the capacity to endure 45 days, 90 days, 120 days while the other side cannot. The side with endurance sets conditions. The side without endurance pays, even when the strait remains open. That is the arithmetic of global fragility. It is not measured in barrels. It is measured in days and in who runs out of them first.